If you've ever made a non-deductible contribution to a traditional IRA, meaning you contributed with after-tax money, and you also have other pre-tax money sitting in any traditional IRA, SEP IRA, or Simple IRA, there is an IRS rule that can force you to pay tax twice on money you already paid tax on once. It's called the Pro-Rata Rule, and it is, without question, the single most misunderstood mechanic in backdoor Roth conversions. Here's the trap. People assume that if they contribute after-tax dollars to an IRA and then convert just that money to a Roth, only that after-tax portion gets taxed. That is not how the IRS sees it. The IRS looks at all of your traditional IRA money combined, every account, every dollar, and taxes your conversion proportionally. Today, I'm going to show you exactly how the pro-rata rule works, a real dollar example showing the double tax effect, and the 3 moves that can protect you from this before you convert another dollar. Under IRS rules, when you convert money from a traditional IRA to a Roth IRA, you can't cherry-pick which dollars you're converting. The IRS requires you to treat all of your traditional SEP and simple IRA balances across every account you own as one single pot for the purposes of calculating how much of any conversion is taxable. The formula is straightforward but brutal if you don't know it's coming. The taxable portion of your conversion equals your total conversion amount, multiplied by your pre-tax IRA balance, divided by your total IRA balance across all accounts. This means even if you specifically contributed $7,000 in after-tax, non-deductible money, and tried to convert just that $7,000, if you also have $93,000 of pre-tax money sitting in a rollover IRA from an old 401k, the IRS considers your total IRA balance to be $100,000, and only 7% of your conversion is treated as tax-free. The other 93% gets taxed as ordinary income, even though you intended to convert only the after-tax portion. This trap almost always catches people who did the right thing for years, rolling over old 401ks into a traditional IRA for simplicity, and then decide to start doing backdoor Roth contributions later in their career, not realizing the 2 accounts get combined by the IRS for this calculation. The rollover IRA and the new non-deductible IRA contribution look separate on paper. To the IRS, they're the same pot. A pre-retiree rolled over an old employer 401k into a traditional IRA years ago. That balance is now $93,000, all pre-tax. This year, they contribute $7,000 in after-tax, non-deductible money to a new traditional IRA, intending to immediately convert that $7,000 to a Roth via the backdoor Roth strategy. Total IRA balance across all accounts, $100,000. Pre-tax portion, $93,000. That's 93%. When they convert the $7,000, the IRS treats 93% of it, $6,510, as taxable income, because that's the pre-tax proportion of their total IRA balance. They pay income tax on $6,510 they thought was already after-tax money. If they're in the 24% bracket, that's an unexpected $1,562 tax bill on a conversion they thought would be tax-free. Many people run backdoor Roth conversions using tax software that doesn't clearly flag the pro-rata calculation unless every IRA account is entered correctly, including old rollover accounts from decades ago that people sometimes forget about entirely. If even one traditional IRA balance is left out of the calculation, the software understates the taxable amount, and the IRS will catch the discrepancy when it cross-references Form 8606 with your 1099-R filings. Move 1. Roll pre-tax IRA money into your employer 401k before converting. Most 401k plans allow reverse rollovers, moving traditional IRA money into your current employer's 401k plan. Since 401k balances are not counted in the pro rata calculation, moving your pre-tax IRA money into your 401k before you do a backdoor Roth conversion removes it from the pro rata pot entirely. This is the single most effective fix, but it requires your current employer's plan to accept incoming rollovers. Check this before you rely on it. Move 2. Convert the entire IRA balance in 1 year, not just the new contribution. If reverse rollover isn't available to you, one alternative is to convert your entire traditional IRA balance in a single year rather than trying to convert only the new after-tax contribution. You'll pay tax on the pre-tax portion regardless, but you eliminate the ongoing pro-rata complexity for future years, since there's no leftover pre-tax balance to keep tracking. Move 3. Track your basis correctly on Form 8606 every single year. If you've made non-deductible IRA contributions in any past year, Form 8606 tracks your cumulative after-tax basis. This form must be filed every year you make a non-deductible contribution, even years you don't convert. Missing a single year's Form 8606 makes it extremely difficult to prove your after-tax basis later, and the IRS will default to assuming the money was never after tax if you can't document it. Common mistakes people make trying to avoid this. Mistake 1. Forgetting about an old rollover IRA from a job 20 years ago when calculating the pro rata pot. Mistake 2. Assuming SEP or simple IRA balances don't count. They do. Mistake 3. Not filing Form 8606 in years with non-deductible contributions, but no conversion, losing track of their basis. Here's your action item this week. Before you make another backdoor Roth contribution or conversion, add up every traditional SEP and simple IRA balance you currently hold across every institution. If that combined number is anything other than 0 going into your conversion, you are in pro rata territory, and you need a plan before you convert another dollar. The checklist: list every traditional SEP and simple IRA you own across all institutions. Calculate your total pre-tax balance across those accounts. Check whether your current employer's 401k accepts reverse rollovers. If eligible, move pre-tax IRA balances into the 401k before converting. Confirm Form 8606 has been filed correctly for every year of non-deductible contributions. This rule has quietly turned thousands of well-intentioned backdoor Roth conversions into unexpected tax bills. Once you understand the pot is combined, it's completely avoidable. If this helped, subscribe. Next up, the AMT landmine hiding in your stock options. I'm May. See you in the next one.